Hello, I am so glad to be with you today. My name is Renia Carsillo, and I'm really excited about this particular group because I was one of you for over a decade. I was a solopreneur for most of my business. And so I have so much heart for what y'all are going through, and I'm so happy to be with you. Just a point of note that I am very Southern, so you're going to get a y'all or two as we go. I cannot help myself. So, a little bit of background about what we're going to talk about today. I started my career right out of college as a commercial lender, was very successful in that space for about 5 or 6 years, and really didn't like the trajectory that my life was on being a banker. And so, I started my business at the height of the financial crisis in 2008, which was a really great time to start a business digitally, but maybe not a great time to start a business in the world. And so I had to learn a lot of things over the course of a decade, mostly on my own. And so some of the things I'm going to share to you with you today are things I really wish I'd known right out the gate, and a few things that kept me from challenges because I was a banker that y'all may not have encountered if you started your company from a different background. And I want to say that if you are not been around in this space long enough to remember what 2008 was like, it was really the beginning of this idea that you could build a business online as a solopreneur. There were people who had done it before, but not a lot. It was really like a very new, very novel thing at that time. And so there were a lot of digital thought leaders just starting to come out. The influencer models that are pretty like ubiquitous today were just starting to come out. And most of my business was originally built on a 2008 era Facebook page. And y'all who were not around then, 2008 is long enough ago that you could put out a post in the morning about what your business was doing at lunchtime, and everyone who followed you would see it, and like 60% of them would show up for the thing you were doing. It was bananas. It was so fun, and really a different time than most of us are probably living in right now. And so I had young kids at the time, and I spent that space really working um, more like I had a job that I had created for myself so that I could do the things I wanted to do with my kids. But something shifted for me in 2018 where I really started seeing the company as a company separate from me. I started to see myself instead of like self-employed, like a solopreneur, like y'all are here identifying as today, right? And when that started to shift, everything started to shift about the financial picture of our work, such that between 2018 and 2022, we went from basically a job for myself to a seven-figure company with 6 employees. So we're still not a giant company, right? We're still a micro business, but it was a huge shift and also a huge shift in what it meant for my family. And what I had to do in order to make that shift was understand some of the most common financial mistakes that we make as solopreneurs and how we can avoid them. And the first one for me was knowing what my 5 year goal was. I don't know if any of y'all have ever felt like this in your day to day, but mostly I was just trying to figure out how to pay my bills in the beginning. And then once I got to the chance where I could pay my bills, I was trying to figure out how to take a vacation. And then once I got to the point where I could take a vacation, I was trying to figure out how I could have health insurance. And I didn't really think farther ahead than what my needs for my family and myself were at that time. I wasn't yet thinking about the business like a business. And the first thing that shifted for me was, and it's the first thing that shifts for our clients all the time, is knowing that 5 year picture. Instead of looking just what I needed for my lifestyle and for my family, what I started to look at is what did I want the business to look like over the course of the next 5 years? Now, I've gotten a lot of advice about knowing your mission for and your why for the whole journey, But my experience is that you learn those things by doing, and you learn them as you're going. And the thing that you think is the why and the mission and early on often evolves into something else later. But 5 years is a really manageable picture, particularly when we think about it financially. So I actually put together a 5 year plan for what I wanted my company to look like in 5 years. And each step of the way gave me more and more space from the business. And that's what was the initial thing that started to make the shift. And yes, that 5 year plan included things like product development and employees and things like that. But as the bias of, a commercial banker, I think even more important was that it had very specific financial plans on how to get there. I looked really closely at what it was going to cost. I did a lot of research and I thought about what type of business I wanted to be. And that is one of the most common mistakes that I see people make, right? Is they think about, like, they read a book about business and they want to be, I don't know, the next Apple, or they want to be the next influencer or something like that. But they don't really think about what type of owner they want to be. And especially as a micro company or a solopreneur, you need to know that and what that financial picture looks like. And so, what we did, I'm going to put up on the screen for you um, what has evolved out of this as we've worked with our clients to help figure this out. We have these 5 archetypes that all have different financial pictures depending on what they want. So, the first one is what you probably think the most traditionally of, right? Which is our fully booked cover band. Our fully booked cover band is like a business with maybe 10, 15 employees, few $1 million in revenue, and they really want to be a founder. Like, they're building a company that eventually they're going to sell, or one of their employees or family member is going to take over. I'm not talking about building the next Fortune 500. I'm talking about building a sustainable micro company that employs some people, maybe in a community, or in my case, in the virtual world. Our employees are all over the country and even now all over the world. The total opposite of that is our solo act. Our solo act is someone who is intentionally what many of us here today are, right? Intentionally a solopreneur, someone who doesn't want and isn't trying to build a company that's going to go on beyond them. And then we have our indie artist, which is a particular type of company that is built around an art form. You see this with authors, visual artists, musicians. It has a little bit of a different financial structure than most other types of businesses that needs to be accounted for because it's mostly based on royalties. And interestingly enough, this is where your influencer models tend to sit. They don't always know it, but this is where they tend to sit. It really, again, the business is driven only by that solo person. Then we have our jukebox heroes. These are like traditional business models, maybe your electricians, plumbers, people in the community. And then finally, we have our crossover sensation. This is what I like to be, someone who does a little bit of all of them. All of these different businesses have a little bit different flavor. They all have a different financial picture that is needed in order for them to be successful. And so I want to just let y'all know, if you're not sure which one you want to be, or where you even maybe where you sit today, you can take this quiz right on our website and it'll tell you where you're at and start you on the journey of building that 5 year financial plan. But what I want to talk to you about now is some of the most common mistakes that are made along this journey. So the very first one, and we can take the archetypes off the screen if we want to now. The very first one is too much spending and not enough investing. So what this means is think about it like in your personal life. I don't want to make anyone feel called out here, but if you've ever spent too much money on a car, and some like person that you know has told you about that depreciating asset, it's kind of like the difference between a car versus a home. So when you buy a car, it loses most of its value the moment you drive it off of the lot. And cars are what we call a depreciating asset. That means that you're pretty much never going to get your money back that you spend. So if you're being really financially responsible, you'll spend the least amount of money possible to get what you need to get the job done, which for me is going from point A to point B. That's why I drive a Prius instead of a Mercedes. Whereas a home for most of us is an investment in our future. We expect the home to gain, all things being equal, right? To gain value over time. So, what we do in our businesses, often as solopreneurs, is we spend money, meaning money that we don't expect to have a return, instead of investing money. And some examples of this in our business is buying ads like Facebook ads or Instagram ads or YouTube ads or things like that too early, which is as soon as we stop doing it, that goes away, versus investing in something like SEO or building an email list that adds value and gains value over time, or investing in social media early on instead of building a referral network or building an email list. Or maybe we buy some really expensive software versus finding and hiring a trusted accountant. I see this a lot with people that get like lost in their QuickBooks. Like, well, what you really need is not QuickBooks per se. You need an accountant who can help you with this stuff. So think about the spends that you have and ask yourself, is it a spend or is it an investment? And what I like to recommend people to do is actually put this out on paper. Now, despite running a digital company, I'm a big fan of analog planning. And so in this case, I recommend taking a piece of paper and drawing a line down the middle and going through every single transaction in your business banking account. Or if you're mixing those things together, go through and just get your business expenses and label in each column. So write them in each column. Is this a spend or is this an investment? And take some time with this. This is a great like hour-long activity. What you want to have is more things in the investing column than in the spending column. And we'll talk a little bit more about that in a minute. Because first, in order to clear that completely, we got to understand this second big mistake we often make with our finances, which is spending too much on coaching and training and marketing and social media, and not spending enough on support. That's like staff or virtual assistants or designers or experts who can help you get things done that maybe are not as maybe not the things that you're the best at, not doing enough selling because we're spending too much on marketing, or not building a referral network. Y'all, I used to be a trainer for the world's largest networking organization. And I can tell you this really saved me in the early stages, is having a set of referral partners who sent me business before I figured out how to generate it in a reoccurring way. A referral network is an investment, both emotionally and relationally and financially, that will pay off for years and years to come if you do it right. In fact, we have this cool tool that we use called a VIP scorecard that I actually just track activities every week. And I can tell you, because we do this ourselves and with our clients, if we get to 100 points, we know exactly how many sales are going to be generated from that. And it's a great way to like feel good about the way that you are generating your sales. All right. So I told you a bunch of things that don't feel like the numbers, right? So what I want you to think about in those areas is, where am I spending versus where am I investing, as we go into some specific numbers things here. Because I want you to understand how you create a realistic financial plan and how you adjust it as needed. And to me, for solopreneurs, it's the difference between an accounting model, which is what you'll learn in a business class, and a growth model that is practical that you can apply on the ground. Some of my shift in thinking on this, to give credit where credit is due, originated with Mike Mikorowicz, who created the profit first model. So I always recommend people, like, he's the OG. That's where I started, because I came out of banking, y'all. I knew about like a profit and loss statement and how to look at all the expenses. And the way I thought about the income from my business, the way I thought about what I got to have, was all the expenses came out. That's accounting, right? All the expenses come out, and then whatever's left over, you get. And early on, I didn't even think of my own paycheck as one of the things that should come out as an expense, which meant I made very, very little money early on, right? Because I paid everybody else before I paid myself. So, as a solopreneur, I think you tend to sit in one of two camps. This is what I see with our clients. We either have over here where they spend everything as if it was all personal income, or more commonly over here where they pay everything out first as an investment, thinking of it as an investment in the business, and don't have enough left over to really do the things they need to do in their own lives. So, what I want you to think about as the first piece of your financial plan is that 50 to 60% of the total revenue, that means all the money that you bring in, should be owner pay as a solopreneur. That means it's your paycheck. That means you should think of 50 in, and again, this is, there are always different use cases, but this is a generally good rule of thumb. 50 to 60% of what you bring in is your paycheck. The rest of it is for things like expenses and taxes and help, coaches, consultants, software, things like that. And so the first question I always want a solopreneur to ask themselves is, where do I sit in this? Am I taking more than 60% of my revenue out of the business as a paycheck? Or am I, more common, this is what I see more commonly, not taking enough? Because that's going to give you a solid foundation. And so, what I want you to do as fast as possible as a solopreneur, this is what we do with our micro companies and our solopreneurs, is we want to get them to 50 to 60% of their total revenue as an owner's paycheck. And yes, we mean a W-2 paycheck, y'all. We get them to, we want all our solopreneurs and our micro companies to have an LLC or a corporation, depending on your model. Check with your accountant or your attorney. And we want a W-2 using a system like Gusto. If they're the only one they're paying, it's very inexpensive, so that you have a couple things cleared up. First, you start getting paid. Because if you're anything like I was, and like a lot of our clients are early on, you're not making enough money. And getting a paycheck, even if it's smaller than that 50 to 60% amount initially, getting a paycheck will do wonders for your mental state. And that W-2 starts to make other things in your life easier. It's easier to get credit cards. It's easier to get basic loans. It's easier to understand your tax burden. In fact, your accountant is going to tell you, once you have one that's a trusted advisor, right? This thing that's like a minimum officer salary that the IRS wants to see. And most of us don't hit that because we're not paying ourselves that way. And it makes things complicated tax-wise. It makes things complicated for our brains. It makes things complicated for how we get paid. And so we've found that putting our owners on a W-2 makes a lot of that complication go away. Now, as you grow larger, you're going to work with your accountant to do things a little bit differently in the way you take money on a W-2 versus as profit distributions or owner distributions. But at the very beginning, what we want to see you get is a paycheck. So that's the first thing I want you to be looking at, 50 to 60%. And are you able to take a W-2 style paycheck? Again, check with your accountant. And an easy way to understand this picture is to use simple tools. I tell my solopreneurs and micro businesses all the time, instead of trying to go down the QuickBooks or the Zero rabbit hole, unless you already have a trusted bookkeeper to manage that for you, to use tools like Wave Accounting or Bench, where it's a lot simpler to use and understand and see your financial picture in just a couple of screenshots. Then what we also want to see is that you get to 3 revenue streams. So the reason we want you to have 3 revenue streams is to make cash flow risk as low as possible. Many of us as solopreneurs only have a consulting revenue stream, which means we're doing essentially work for hire. If that's you, your goal is to build a second revenue stream that generates some kind of cash that you don't have to give service for. So for us, that looks like we have some thought type pieces that we sell. So we have templates. We also have a lot of affiliate revenue from referrals and things that we recommend our clients use. And we are about to have, in 2 months, we're about to have product. So where can you get into a second revenue stream? If you're in a consulting space, usually the affiliate route is the easiest route. What that means is you get paid every time you tell one of your clients to use a service or a product. And that starts to make it easier to generate additional cash flow. I want to say one other thing to you about cash flow and your revenue streams. If you already have more than one revenue stream, it's super important that you work with your bookkeeper or accountant to track which ones of those are the most profitable. So sometimes if we are selling lots of products or lots of different types of services, some of them make us good money and some of them don't. And usually what we do as solopreneurs is we only look at what the biggest checks are. So what brings us the biggest amount of cash checks? I'm dating myself here. What brings us the biggest deposits in our bank account? Those are the things that we focus the most on. I can still remember, y'all, the first time I landed a 6-figure contract, I thought I'd made it. I was like, oh, this is going to be amazing. And this is going to be, and then I didn't realize how much of that was going out in cost, right? So we want to know what those different revenue streams actually generate for us in net revenue, not just what the sale is. And we call that margins, meaning what you get paid versus what you spend. Your margins, y'all, as a solopreneur, are more important than how much you sell. And I've learned this lesson time and time again. I actually learned it the very first time when I was 22 years old as a commercial banker. If you can sell, nothing feels worse than when you sell millions of dollars and as the owner or the founder only take home, $10,000, $15,000 at the end of the year, or worse, lose money at the end of the year. And we do that because we don't understand that margin concept, the difference between what we sell and how much it costs and what's left over. So all of those are very basic accounting tools that start at the very beginning. But the very first thing that I want people to understand before you go into the numbers at all goes back to the beginning. What is that archetype? What's your 5-year plan? What type of founder do you want to be? Do you want to stay a solopreneur for the next 5 years? Awesome. Then we want to build your financial picture and you want to talk with your financial team, your accountants, your bookkeepers about your solopreneur journey. If you want to build a team, if you want to be that fully booked cover band, then you need to start a different plan and you want to choose your partners accordingly. You want to create your financial picture accordingly. So the first step is always to know, what do you want over the course of the next 5 years? And that's going to give you the foundation you need to start looking at your numbers in a way that you can build a sustainable financial footprint so that you're there when you want to be there. Thank you.
Thank you so much for that amazing elaboration on what you should be doing. Because I know, for example, I got stuck in the beginning. I wasn't paying myself. And then I started paying myself W-2. And as an owner, you shouldn't, that's another hack. Like, you shouldn't pay yourself too much when you're on W-2.
Yes.
So there was a lot of things that I had to learn. Because I'm like, all right, Uncle Sam, just take the money and then my CPA. So yes, get an accountant, get a financial professional to help you with this, because it gets tedious, it gets crazy, and if you don't have the right preparation, if you're not aware of what to do, then you get stuck. You get stuck, you get overwhelmed, you get confused, and you start making a lot of bad decisions. And bad decisions, we know, will impact your finances. And which you hinted at as well, around, right, the getting that six-figure contract. It feels like, oh my gosh, we've made it. But what you've made it into is a whole nother bucket of problems, because once you hit that mark, there's a lot more things that end up happening that you are not prepared for. You're not prepared for in the least bit, such as, when you hire people, there are work, what's it called? Employment things that, what is it? Taxes that you have to, extra taxes that you have to pay,
So many
workers'
taxes.
compensation, and W-2. Man, the list of taxes that you can pay for random things, and then insurances that you need. So once, going from 1 to 2 is such a big difference financially, that you have to get the proper support and resources tacked in. So thank you so much for sharing what you know. And definitely, what's the best way for folks to contact you after this session?
Yeah, they can find us online at realignyourstrategy.com. And thank you so much for having me here. And if they want to take the archetype quiz, it's right there at the top of realignyourstrategy.com.